My name's Aaron March, and in this video, we're going to answer the question, what is Division 7A? Division 7A is all about owners and shareholders taking money out of a company. In Australia, how a company works is that a company is a special legal environment set up for running businesses, and the government says that while you've got your money in a company, you get access to a special tax rate called the corporate tax rate. This can be either 25 or 30%, depending on how big your company is. Now let's have a look at a few scenarios about how you can get money out of a company. And we'll use this example here, assuming this company has got $1 million in retained profits that it now wants to get out to shareholders. One way that the owners can get the money out of this company into their own hands is to simply pay themselves a salary and wage of $1 million. So they just pay themselves a salary and wage. But if they do that, then they're going to get a tax bill of $440,000. So you can see that there's that second point of tax. Another option available to them is to pay themselves a franked dividend. And you can see if they do pay themselves a franked dividend, they again get a tax bill, and the tax bill will be $245,000. It's less than the salary and wage because they get the benefit of the franking credits, the tax that the company's already paid. Importantly, what you can see here is that under both scenarios, salary and wage and franked dividend, when money comes out of a company, there is a second taxing point that you have to deal with. There is a third way to get the money out of the company, and you can just simply loan it to yourself. The great thing about this is that there's no taxing point on a loan. This is a really popular strategy in the late 80s, early 90s, and it worked really well. However, in 1997, the ATO introduced what they call Division 7A, which are the rules that are aimed at addressing this second layer of tax when people loan money out of a company. Now, if you do have one of these loans, it's so important that you deal with it, because if you don't, the whole amount of the loan, the $1 million, will be treated as an unfranked dividend. And what that means is you'll get the same tax result as if the whole million was paid out in salary and wage. So you'd get a tax bill over here of $440,000. Okay, let's have a chat about the timing on dealing with these Division 7A loans. You have to have dealt with it by the due date of your tax return in the year in which the loan arose. So for example, if you took money out during the year ended 30 June 2025, you have to have dealt with the Div 7A loan before you lodge the tax return for 30 June 2025. There are a number of ways you can deal with your Div 7A loans, but I'm just going to cover off two of them. And first of all, the most simple one is, of course, simply just repay the loan. So the shareholder, the owner, just puts the money back into the company before the due date of the tax return, and you've dealt with the loan. Another way of dealing with these loans is by putting on what's called a complying loan agreement. And what that means is that the shareholder repays the money to the company over 7 years, and they make payments of principal and interest to the company. Now, in reality, the shareholder doesn't pay cash back to the company. What happens is the company declares dividends to the shareholder, and the shareholder uses those dividends to repay the loan. So you can see that that's a little bit confusing. So I'll put it this way. What happens is, think about if you get a dividend from Telstra or BHP, they send you the dividend, you get a cash check, and then when it comes tax return time, you put the dividend in your tax return and you get a tax bill associated with your dividend. What happens in this scenario is that the company will pay a dividend to the individual. The individual, instead of receiving the money, uses it to reduce the amount that they owe the company. Then in the individual's tax return, they put that dividend in their return and they get a tax bill associated with the dividend. And so each year where the repayments are funded by dividends, the loan balance will go down, the shareholder receives a dividend that they put in their tax return, and they get a tax bill associated with it. The complying loan agreement allows the shareholders to pay off the loan over 7 years and deal with the tax associated with taking the money out over 7 years, as opposed to paying it all out as a franked dividend in year one. Okay, wrapping up, what have we learned? We've learned that for business owners, when you keep your money inside of a company, you get access to the corporate tax rate, so you can retain your earnings and reinvest in the economy. However, then when you want to take your money out of a company, there is a second layer of tax. One way of getting your money out of a company is via a loan. And if you do that, you create a Division 7A loan. And you need to deal with your Division 7A loan by the time you lodge your tax return for the year that the loan originated. Common ways of dealing with the loan is to simply repay the loan. The second way is to put on a complying loan agreement and repay it over 7 years. I hope this video has helped answer the question, what is Division 7A?